Welcome back to Switzer. For a cold-faced view of what's going on in the stock market right now, we have Julia Lee from Bell Direct. I'm going to ask her how she's investing right now. That's the interesting bit. Hi, Julia. How are you?
Hi, good. How are you doing?
I always see you on TV and people ask you what happened, but no one ever asks how Julia Lee's investing. Only I ask that.
You could have given me a little bit of warning.
No,
but,
I give warnings on this show. People like you are competent. You can do it. But let's start off the easy stuff first. What do you reckon is going on? You think a correction is going to come, or do you think every correction is just going to be a shallow dip because everyone gets in there and buys?
I think there's a couple of things going on at the moment. First of all, in terms of valuations, the share market is looking relatively high. We're seeing a PE valuation of 17 at the moment. And if you go back to the past 10 years, that's been at the upper range. 17, 18 is usually what we hit before the market pulls back down again. But having said that, when you look at a valuation like the PE ratio, there's two inputs. One's a price, and the prices have been going up, but the other input's earnings. So as earnings rise, valuations do come back down. And I was reading a survey last week. It was a Dun & Bradstreet survey saying that earnings growth expectations were the highest in about 10 years.
Yeah.
So if we do see those earnings expectations and earnings growth eventually,
E goes up and the PE value goes down.
So the market starts to look a bit more reasonable.
Yeah,
Again.
it just seems to me, you would have missed it. I looked at an American investment survey, and I think in November 34% were bullish. It's now gone up to 53% or something like that. And I think once the mums and dads pile back in, and I think the growth of mutual funds in the US is up about 167 billion this year.
Yeah.
Now, that once they go in, mums and dads kind of stick, don't they? They don't go in and out so quickly. So I feel as though I can't see a big correction unless there's a scary thing from left field.
Yeah, well, the macro conditions have been the best that we have seen in years since the global financial crisis. You know, Europe's looking relatively all right. We're seeing the US improving and even talk of tapering because, you know, the economy is looking strong enough. So I think in terms of the macro view of the market, things are looking pretty good. And here domestically, you know, interest rates are still relatively low. We're going to see earnings growth this year. I think things are looking pretty good.
So that earnings growth that you got from Dun & Bradstreet, you also would have seen all the analysts. The analysts are kind of reinforcing the same view, aren't they?
Yeah, I think there's, I guess you can put the stocks in a few different camps at the moment. One is where we are starting to see a little bit of a recovery coming through. That's in stocks like JB Hi-Fi, Aristocrat Leisure, Challenger Group, Macquarie, where we are starting to see...
And there were strugglers 12 months ago,
absolutely,
weren't they?
and they've seen some phenomenal share price performances, and we're seeing a bit of earnings growth coming through. We're probably at the beginning of the cycle, so things are looking pretty good for companies like that. And then we're seeing expectations of an earnings recovery in some stocks driving up prices, and there's stocks like Harvey Norman, the Myers of the world, Fairfax, Seven West Media, these type of stocks, where the expectation of a cyclical uptick is driving up these stocks, but we actually still have to see that growth coming through. So we're waiting for that growth, and that's probably the more riskier basket where the stocks have already started to run in anticipation, but we want to see that growth.
Okay, so you had the courage to put your mouth around the word Fairfax. Now, it fits the cyclical
recovery
category.
Story.
But what do you think of the company?
Yeah, it's a difficult one. I think with the media stocks, there are a lot of challenges still out there. So the structural challenges, I think, will remain, but the cyclical conditions are going to
So they'll
get
better just because the cycle will be better and people will take out advertising.
I mean, we saw News Corporation coming out with its first quarter earnings today, and that was a reality check because we did see it returning to profit in the quarter, but that was simply because of the Fox Sports revenue that came through. If it was just on the back of the newspaper revenue, you know, we would have seen a huge.
And that worries me for Fairfax. I think they're improving their digital offering, but I don't know if they're making a lot of money out of it.
Yeah, and I don't think it's a quick turnaround story. I think you have to wait a couple of years to see whether some of their strategies are going to come into play.
Fairfax investors have been waiting a long time for a turnaround.
Last 18 months, it's been all about cost cutting, and hopefully we'll start to see cyclical conditions improving and some extra revenue coming through on the advertising side, especially in terms of digital advertising.
What about 10?
Yeah.
Have you tuned into the breakfast show? You're young enough to watch it.
I have. I think it's good that they are trying out programming because I think the programming is the key here. If they do start to get some good viewership, then we'll start to see the advertising
Did you come back
dollars.
the next morning?
I have been keeping an eye on it.
Oh, okay. Yeah, from an older person who I know watched it, thought, oh, it's not my demographic, but it seems okay.
But you know, I'm addicted to the markets. I'm on Sky Business.
Yeah, I know. Yeah. Funny that. But do they have a finance reporter on that show?
I haven't seen one as yet.
Well, that's
I've
kind
only
of
been
crazy,
flicking
isn't
through.
it?
Yeah,
it's kind of crazy. Maybe it should be you. Anyway, now, all right, so that's 10, that's Fairfax. You mentioned Aristocrat Leisure. I've already done Tabcorp tonight, so this, while we're in the gambling area, you got a good outlook on that?
Yeah, I think Aristocrat Leisure's one of those companies which is actually seeing an uptick from the recovery story in the US, and then of course the Asia story as well. I think we've seen with Crown, you know, Macau's such a big part of the story of Crown at the moment, and Crown's been doing fantastically well this year. I think in 2013 the stock's up more than 50%, and that's compared to a stock like Echo Entertainment, which has actually gone the other way. I think it's down 15%. So I think Asia's a big growth story, especially for Aristocrat Leisure, and then the traditional markets like the US seeing a recovery there in terms of the economy is helping out Aristocrat's business.
Okay, so that's like an overview, but what is Julia Lee doing right now to make money?
Well, there's two things that I look for when I'm looking at investing in the market, and that's both earnings momentum and price momentum. Now, both of these, there's been a number of...
You want everything, don't you?
I want everything.
I want everything, earnings and price.
But these are two effects in the market which have been showed over time. There's a number of academic studies supporting momentum. And I guess if we have a look at earnings and price momentum, it's combining two of my favourite areas. One's fundamental analysis and one's technical analysis. And I think having the two together, you get a better idea. At the moment, I'm looking more in the small cap and medium cap space. As you could. Because the large cap space, it is looking a little bit expensive.
It's been chased and a good day has been taken out. Yeah.
So I don't want to mention too many stocks because some of them are smaller.
Just take one and talk to the price movement, because when you say price momentum, and this is where a lot of people get a bit derailed. They miss the early part of the price rise. I think, I don't want to jump on now because I missed the early part. Obviously, with your strategy, you need to see a bit of price momentum, which you miss out on before you get in.
Absolutely. Once the price momentum turns, that's when I...
Well, I remember when we talked about Telstra at 250 or something like that, and it was just starting to come up, and that was a good time to jump on that price.
That was a fantastic time.
It was a good one, plus dividend as well. Anyway.
So some of the stocks I'm looking at, I'm in at the moment, they include stocks like Big Air, and some of the things... Big Air. It's a little telecommunications company.
Big Air, A-I-R, yeah, okay.
So maybe a smaller version of Telstra. It's got broadband services, ISP
Small
services.
version of Telstra.
A lot of these have been doing well, but if you have a look at the earnings momentum, and we are seeing positive earnings growth there, and that's good. As long as that continues, I'm positive on the stock.
All right, so Big Air, how long has this company been around for, you know?
A number of years. I remember
so it's been around for a while.
to them in terms of the internet around about 6 years ago. So I think maybe around about a decade.
So you've seen the price go up, and you've liked
earnings momentum
the earnings
has
outlook?
gone up, and the price momentum's looking good. And what I look for, I look at very simple things. So 3 moving averages, the 50-day, 100-day, and the 200-day. And I just want to see the slopes all moving upwards. And the slope's still moving upwards, and as long as those slopes are moving upwards, then I'm positive on price.
Okay. Now, a company you couldn't support because it had plenty of price earnings momentum, but the earnings momentum is zero.
Yeah, well, that's a really difficult one.
That's a hard one. And I told my viewers about it. I did the MC job for Zero when it was $12. And I came and said, this is a great company, but no one could...
$32 now.
I know. No one could, like Roger couldn't talk it up. Jeff Wilson couldn't because the earnings weren't there.
Yeah.
So you do miss some blue sky companies when you have the P and E analysis.
Absolutely.
Okay. So are there any other companies that fit this bill? P and E head in the right direction.
Logicams, now it is in mining services, but it's more in the it's more in the oil and gas space.
Yeah, and which is the stronger part of the mining area.
It's unusual to continue to see earnings growth as well as price growth momentum in this area, so it's been doing quite well as well. And then I guess looking at some of the bigger stocks and maybe just shuffling around the portfolio a little bit. I mean, at the moment, it's the banks that are very much in focus.
Yeah. And are you, if say one of your friends or family came to you and said, well, look, I only want 8 or 10% return each year, are the banks still a go? I'm retired, there's 5% dividend, grosses up to about 7%. Banks will go up about 3% this year, Julia, won't they? So what's wrong with buying a bank for 10%? What would you say?
I think if you're buying the banks based on wanting income, that's fine. But if you're buying the banks based on capital growth, I think that's a little bit more risky.
But you get 3% if the market goes up to 6,000, like Charlie said.
Well, we've just seen reporting season, and I guess the banks are the most expensive that they've ever been historically. So 2.2 times book value. Now, if we continue to see growth in terms of credit, well, that's a positive for the banks. But I guess if you have a look at the bank earnings and you sort of strip out all the bad debts and the taxation consequences, you know, they're not really doing too much.
Okay, you did your best. Thanks very much, Julia. Always great talking to you. If you want to read my thoughts each morning at the close of Wall Street, check out my website, switzer.com.au. And if you have a self-managed super fund, have a look at the switzersuperreport.com.au website. I'm Peter Switzer. Thanks for joining us. Julia Lee up next. Aren't you lucky?